Welcome back to Smart Money and Mind channel roasts your wallet. We have breaking news today. The Federal Reserve has officially turned the money printer back on, cutting interest rates and signaling a major shift in the economy. This is one of the most important financial moments of the year. And whether you're an investor, a homeowner, a saver, or someone just trying to build wealth, this decision will directly impact your wallet in the next 3 to 12 months. Today we're breaking down why the Fed cut rates, how this turns the money printer back on, what it means for inflation, what it means for your investments, and the number one move you should make right now. Let's get into it. The Federal Reserve just announced a rate cut, meaning they lowered the federal funds rate for the first time after a long period of tightening. In simple terms, when the Fed cuts rates, money becomes cheaper. Cheaper money. More spending, more borrowing, more investment. This is why people say the money printer is turning back on. Even though they're not literally printing cash, the effect is the same. Banks can lend more, businesses can borrow more. People can finance homes, cars, and projects more cheaply. Markets get flooded with liquidity, and liquidity is like fuel for the economy. But this shift comes with big consequences, both good and bad. The Fed cut rates for 3 big reasons. Reason number 1, the economy is slowing, consumer spending is cooling, hiring is softening, several business sectors are contracting, the Fed wants to avoid a recession. Reason number 2, inflation is moving closer to their target, inflation has been trending down, giving the Fed room to cut without overheating prices again. Reason number 3, political and market pressure. The government, Wall Street, and big institutions all benefit from lower rates, rate cuts, lift asset prices, boost markets, lower borrowing costs, improve consumer sentiment. It's the fastest way to stimulate the economy without announcing a stimulus package. Here's the simplest way to understand it. When rates go down, money becomes easier to get. When money becomes easier to get, prices go up because people start buying homes, investing in stocks, refinancing loans, expanding businesses, taking on new projects. This increase in spending makes the economy look stronger, but it can also cause inflation to rise again if things heat up too fast. So yes, the money printer is effectively on, but it's controlled, not chaotic. Let's break down how this affects your life directly. 1. If you have debt rate cuts, usually lower, credit card APRs, car loan rates, student loan refinancing, personal loan rates, this can save you thousands in interest over time. 2. If you're a home buyer or homeowner, mortgage rates may gradually come down, not instantly. Lower rates, just cheaper monthly payments, higher approval chances, more buyers entering the market, home prices rising again. This can help and hurt. Good. Refinancing becomes possible. Bad. Housing gets more expensive as demand increases. 3. If you're an investor, rate cuts are historically bullish. Stock markets love cheap money. Typically, tech stocks rally, growth stocks rally, real estate stocks rally, bonds become less attractive. The S&P 500 rises months after cuts. Over the last 50 years, the market has risen 83% of the time in the 12 months following rate cuts. 4. If you're a saver, bad news, high-yield savings accounts may lower their APYs. Your 5% savings account might drop to 3.4% as banks respond to rate cuts. It's still good money, but not as good as the last year. This is the part most people worry about. When the Fed cuts rates, money moves faster, spending increases, borrowing increases, markets heat up. This can push inflation higher, but the Fed is cutting carefully. They're signaling multiple cuts, but slowly. So instead of runaway inflation, we may see mild price increases, higher asset prices, stronger markets, improved consumer confidence, but not the chaos of 2021-2022. Still, if the cuts are too fast, inflation can come roaring back. Time will tell. If I were advising the average person today, here's what I'd say. Position yourself to benefit from lower rates before everyone else reacts. That means, 1. Strengthen your credit. Lower rates mean nothing if your credit score locks you out of loans or refinancing. 2. Increase your monthly investments. The market historically rallies after cuts. This is prime investing season. 3. Lock in high-yield savings before APYs drop. Move money into fixed-rate products, CDs, treasuries, while rates are still high. 4. If buying a home, get pre-approved. Now. When rates drop, competition explodes. 5. If you run a business, expand during cheap credit windows, growth becomes more affordable. This is how wealthy people use rate cuts, as opportunity windows, not headlines. The Fed turning on the money printer, even gently, is a massive shift in the financial landscape. Whether this becomes a blessing, a danger, or a once-in-a-decade opportunity depends entirely on how you respond. Prepare early, invest consistently, and position yourself before the ripple effects reach everyone else. Thanks for watching Smart Money and Mind channel, Roasts Your Wallet.